our very own Mission del Paso tutor, Enrique Lechuga. This session will be recorded so that you may come back to it later if you need, and so others who may have missed out on today's events will be able to come back and watch it. Thank you so much for joining us today. So now, at this time, we ask that you please mute your mics for the best sound experience. Otherwise, the feedback could interfere with the information in this session. So, without further ado, here is our presenter.
Thank you, Patricia, and good afternoon to everybody. Thank you so much for having me on here today as we go over credit card debt for this super awesome and super fun topic on here. I'll be completely honest. I do know that when we're talking about credit cards and credit card debt, it is not the most amusing topic, but I will do my best on here to make it engaging, to make it fun and applicable. And my goal for today is that I do answer any questions you all might have, and at the same time, just go over some useful things and topics on here as we do go over credit card debt. And I do believe, Patricia, are you able to move the slides for me, or?
Right at the bottom of the slides, you should see an arrow. You can change
I
your
see it.
slides there. Yes, sir.
Awesome. Thank you so much.
You're
Appreciate
very
you.
welcome.
But awesome, guys. As Patricia did say on here, well, I would want to start off by thanking our moderators today for Clara, Gemma, and Patricia that have made this presentation possible. I thank you so much for today. As I had mentioned, my name is Enrique Lechuga. I had the huge honor today about going over credit card debt. And the last time I had the privilege of being able to do a presentation on credit reports and credit scores basics. And I know last time we did have several questions. So today it'll be centered just on credit card debt. And let me start getting into it on here. There we go. But awesome, guys. But thank you so much again, once again, for joining us. So just a little bit about myself and letting you know why I'm talking about this and how my experience came to be. So my name is Enrique Lechuga. I'm very fortunate that I've been able to get a MBA out of UTEP, and currently I'm working on my doctorates of business administration in Grand Canyon University. As Patricia did mention, I am an academic tutor at the MDP campus. And to be specific and going over this topic on here, my experience does come from banking. I did do banking for a little bit over 10 years, which is where I learned most of my knowledge on here about credit cards and how they work. And then since 2019, I've actually been a credit consultant where I do help people learn about credit, helpful credit tips, and also helping them get their score ready and their reports ready for any client that does want to buy a house. That's a little bit about myself on here. And then over here, I do have the list of the things that we'll be going over today. So just a couple of things we'll be going over. So credit card basics, the benefits of using credit cards, how to manage credit cards, how to use them to help with your credit score, how to best get out of credit card debt. And the biggest thing on here is to answer any questions you all might have. I'm gonna be completely honest on here. I do have about 15 minutes worth of material for a 50-minute presentation. So I'm looking forward to some engagement and to answer any questions that you all might have. Just a couple quick things that I always tell when I do make a presentation like this. If there's something that I say that wasn't clear, just let me know right away. When I practicing for this presentation, I noticed that I was using some lingo that is something that I use on a daily basis, but the individuals who were helping me out practice for this, they kind of let me know that there's some stuff I'm saying that might not just be common knowledge. So if I do say something that wasn't clear, just let me know right away. If I throughout the process, throughout the presentation, if you do have any questions, if you want to type them in the chat or raise your hand, that way I can get to those questions as soon as possible. And one of the things that I always share is that I've been doing this for quite a while on here, and I do consider myself quite savvy. But it does happen from time to time where I do get a question that I do not know the answer to. So if that is the case, trust me, I'll get back to it as soon as possible. I might be able to get an answer before the presentation ends. Or if not, I'll go ahead and get back to you with that answer. One thing that I always also share, keep me accountable, guys, because I tend to get excited about this topic and credit basics and all. So if I start talking really fast, just let me know on here as well, and I'll slow it down a little bit. Awesome. But I do have a couple quick facts that I want to go over regarding credit cards and how they're used here in the United States. And these are all statistics as of the beginning of 2026. So the first one that I do have on here is that 648 million credit card accounts are actively open right now, which is a huge number if we think about it. I mean, we do have about 330 million citizens in the United States. And not all of them are adults or able to have credit cards. So that is a lot of credit cards that just within the United States, considering that a lot of the world does use credit cards. This one on here did get to me on here, the total debt. So in the United States, we do have $1.39 trillion in credit card debt. The average household does hold about $9,000, a little over $9,000 in debt, which is a big amount on here, if you ask me, considering that, as we'll see in a little later, this is debt that does go from month to month. So that is quite a big amount on here. Also, the utilization ratios is between 31 to 35%. And just to kind of let you know, the utilization ratio specifically, what that is how much out of your credit cards you are using. So just to give you a quick example, let's assume you have a $100 credit card, excuse me, and you do use $30 out of that credit card, $30 out of the 100, that does put you at a 30% utilization ratio. So that's how that number is calculated on here. As far as ownership, 82% of American adults have at least one credit card that they are using. The average American has 4 credit cards in regular use. Excuse me. And the balance carrying. So 46% of card holders carry a balance from month to month, which means that they're not paying them off in full every month. And then the average interest rate is at a 20% rate, which, if you ask me, considered or comparing to other loans, is a huge amount on here. And one of the reasons for this topic on here is that I want to show some tips and hints on how to stay away from credit card debt and how to get out of it as soon as possible, so we're not paying that high interest on those credit cards, and hopefully not staying into that vicious cycle of being in debt pretty much for life. And I got a question on here already. Does this, let me go back to it on here. And the question is on here, does these numbers include the prepaid cards of like when you put money on the card to get it? No, so this is just unsecured debt. And we're gonna go over a little bit, okay, so like when you have young people start off that they have to pay $300 for a credit, for a $300 limit card. So excellent question on here, and to kind of address it. So, and we'll go over it a little bit more in detail in a little bit. What Patricia's talking about is a secured credit card, where you have to make a deposit on here. But no, specifically this amount on here is just for unsecured debt, where what that means on here is that you do not have to make a deposit to get that credit card. If that was confusing, we're going to go over it a little bit more in detail in further slide. But to address Patricia's awesome question on here, no, that is just for unsecured debt. So it's 100%. Oh, that is exactly correct. Yes, ma'am. So this numbers on here is for what's called unsecured debt, unsecured credit cards, where meaning that the bank lends you this amount. You don't have to make a deposit, or you don't have to secure it with any form of deposit or cash on here, if that makes sense. Does that answer your question on here, Patricia? Awesome. And like I said, for some of this stuff, we'll get into more specific details in a little bit, but that was an awesome question on here. But those are, if you ask me, staggering numbers on here. I mean, they're just the amount of people that are in debt on here. And so again, the whole point behind this presentation is for us to be able to use credit cards to our advantage on here. And if anything, if we are in some credit card debt, what are the best practices to get out of that credit card debt? And so this is where I want to start asking for some engagement on here. And I know it's a very vague question, but and then you can type it out, or you can answer your raise your hand and tell us. But how do you all define credit cards? What do you think a credit card is? A card that lets you get borrowed money. Perfect. That is pretty much, in essence, buy now, pay later. That's an awesome way to put it as well. I do want to apologize that because of the wind, allergies are acting up. So I have this little cough going on. So if I take a little pause on here, excuse me in advance. But we'll stay with those answers on here. So Patricia did say that it's a card that lets you get borrowed money, buy now, pay later, and borrow money for purchasing whatever, but you pay interest. Absolutely. Great point by Liz on here that as we showed in the previous slide, it can be a very, very expensive form of a loan. Money at your fingertips as a temporary solution. I love what Della just said on here, that it is a temporary solution on here, which is what it's meant to be. Let me go on to the next slide on here so we can go over some specifics. So these are just definitions that I brought out of Google, to be honest with you, and that way we can go over them on here. But specifically, a credit card is a financial tool that allows you to borrow funds from a financial institution up to a certain limit to make purchases or obtain cash advances. So just to kind of go into details about that. So as the ladies awesomely put it on here, so it is a loan on here that specifically a credit card, it's on plastic. That's the way I usually like to describe it on here. It is a plastic. It is a card that they give you that you're able to borrow against it on here, usually coming from a bank or credit union or a finance company. And what will happen is, depending on your income and depending on your credit scores, they will give you a certain amount. So I'm sure many of you all have some experience with this, where you might apply for a credit card and they might give you $1,000. I know sometimes they'll give you a lot more, and a lot of the times they will give you a lot less as well, which can be dependent on, like I said, your income, your credit scores, and or also your credit history. So for example, I know somebody earlier put about getting a credit card at a young age, usually like at 18, something like that. They might give you a small limit on here, maybe 100, $200, just to see how you're going to be using it, the credit card, before they start increasing those limits on here. Starting to address the second bullet point on there specifically, and I'm just getting some definitions on here. A credit card is a form of revolving credit, meaning you can spend, repay the balance, and spend again, with the option to pay in full monthly or carry a balance while paying interest, which is exactly what Liz said on here a little while ago. um, and just specific to that point, there are two types of loans. I'll do a little pop quiz on here, but I know this is very specific to this field on here. But this one of the type of loans is revolving credit. Does anybody know what the other type of loan that gets reported to the credit bureaus is? Title loan, it is under that umbrella on here, but that is a very, very good answer on here. School debt as well. That falls under this umbrella of the specific answer that I'm looking for. And like I said, I know this is very specific to this field, so I'll kind of share it on here. But the two type of loans, one of them is revolving credit, which is like the credit cards and line of credits. Going back to that definition, something that you can use, repay, and spend again, with the option of paying it off fully in month and or carry a balance. So perfect example of that is a credit card. Well, let's assume if you have $1,000 credit card, you're able to spend some of it or all of it, and then as you pay it down, you're able to use more of it, depending on what the limit and what your available credit limit is. The other type of loan is what's called an installment loan. And an installment loan is a specific loan amount. So let's assume, like I know Patricia said, title loans, school debts, they fall under installment loans. Think also of personal loans or car loans or mortgages, something where they lend you an exact amount and that your payments are going to be the same for X amount of time. For example, let's assume you get an auto loan for $20,000. They're going to tell you, hey, your payment is going to be $400 a month for the next 4 or 5 years. And so that's an installment loan. So again, it's a specific amount for X amount of time, and you cannot borrow against that loan anymore, the way you would with a revolving credit, which again is the reason why I'm going a little bit more over revolving credit is because that is a form of loan that a credit card is. I got some great answers on here. Any questions so far regarding these definitions on here? Awesome. Okay, let me move on to the next slide on here. How old do you have to be to get a credit card? That's an awesome question, Patricia. To answer that question directly, you do have to be 18 years of age to be able to get a credit card, but there is a little bit of a loophole around that. And that loophole being um, adding somebody as an authorized user to a credit card. Um, So for example, let's assume, and this is a great way for to help out somebody that's starting off with their credit. So let's assume you have a 16-year-old son or daughter, and you want to help them establish their credit. A lot of companies, credit card companies or banks or credit unions will allow you to place your son as an authorized user on that credit card, and that credit card will start getting reported on the credit report the same way it does with yours. It does put it on the credit report for that individual that you're adding as an authorized user. On the credit report, it will show up that they're an authorized user, but nonetheless, it does help them establish that credit. Now, it does depend on the institution itself. So, for example, a common credit union here is in El Paso's GECU, so I kind of refer to them a lot. Not that I have any affiliation with them, but let's assume you have, as an adult, you have a credit card with GECU, and you have a 16-year-old son or daughter. You can call GCU, and it's up to them to decide what age they can start reporting it at. That will help out that individual. For the most part, from my experience, I've seen it that it's at 16 where you can start adding them. I have seen some local credit unions do it at a much younger age, I believe 13, but it's up to them, to that financial institution. But to address your question specifically, to apply yourself for a credit card, you do have to be 18 years of age. Hopefully that answered that question on here. And then I know I got another question from Liz. It says, do installment loans usually have a higher interest rate than credit cards? That's another awesome question on here. And it's actually the opposite on here. So installment loans tend to have a lower interest rate for various reasons. Um, Off the bat, it is very common that installment loans are secured. And what I mean by that, it is secured with some type of asset, whether, for example, a car loan is technically, it is an installment loan, but it's also a secured loan because you're securing it with that vehicle. So pretty much if something were to happen where you cannot pay that loan off anymore, the bank will repossess that vehicle, and that's their collateral. That's what they're securing it with. So, and then also installment loans tend to be, like I had mentioned, even if it's unsecured, where it's a signature loan. So let's assume you go to a bank, you apply for a loan, you do not secure with any type of collateral. It's what's also called a signature loan. It's another way of saying it. That's because it's usually a fixed loan with X amount of payments for X amount of time. The interest rate on installment loans tend to be lower than credit cards or revolving credit. For the most part, that's usually the case on here. But credit cards is actually one of the highest interest rate loans that you can get. Again, kind of the reason for this presentation and trying to avoid credit card debt, trying to avoid us being in a lifetime worth of credit card debt, and how to get out of credit card debt. Hopefully that answered Liz's question. And then I do have another question on here by Patricia that says, which credit card company do you recommend? Visa, MasterCard, Discover, a private bank? That is an awesome question on here. I do have a little slide with a little bit more information on it. And the direct answer to that one, Patricia, it varies on here. I know that's very vague, probably maybe not what we were looking for. Let me see where that slide is at. Maybe I can get to that one here in a little bit, or is that one next? But yeah, so a lot of the credit card companies, they have various benefits on here. So as you all might know, the most common one are Visa and MasterCard. And Visa and MasterCard, they are not banks themselves. They're the ones that just provide the plastic, but they're the most common ones that, because of what they do, they usually offer some benefits on here. Um, and kind of start addressing your question on here directly, I do usually recommend that everyone has at least a credit card that is a Visa or MasterCard, because those are the ones that they take most places on here. Discover, I know most places do take Discover as well. Another one is American Express, and I know some places take American Express, but not all places do. Um, And then it also depends because, like I said, Visa and MasterCard, they're not the banks, they're not the ones lending you. From there, you can either get a credit card from a bank, a credit union, um, and then also you have your store credit cards. And that one specifically we'll get into in a further slide on here. So hopefully that answered your question a little bit, Patricia, but I'm sure the other slide will address it a lot more on here. You guys sure have some amazing questions on here, and I thank you for that. Let me see. Let me go on to, before I move on, any other questions regarding this slide? And if anything does come up on here, just let me know, or we can come back to it. And at the end, I do have a slide on here where for any questions on here. So if you think of something and we need to go back to it, just let me know on here. But now specifically talking about just a revolving credit, there's two type of loans that fall under revolving credit, that are credit cards and line of credits. Both of them are very common on here. Of course, credit card being a little bit more common than line of credits, but specifically by definition, a line of credit is a flexible loan arrangement with a financial institution that allows you to borrow up to a maximum limit, repay it, and borrow against needed. A traditional loan, you only pay interest on the amount you actually use, not the total approved limit. So both of this type of loans, the credit cards and the line of credits, they are work very similar. Pretty much the way I like to compare it is that credit card has a plastic, a line of credit, usually you have to call the bank to make a transfer out of it and or do it online. But they work very similar in the sense that when you apply for it, they're going to tell you this is how much you qualify for. So let's assume you go to your credit union or your bank and you say, you know what, I need a line of credit for some purchases I might be making. They'll tell you, okay, you qualify for $1,000 line of credit. Then the way it usually works is that you either have to call or make a transfer online from this line of credit to your checking account, and that's the way you can start using it. So very similar as a credit card. The only difference behind the credit card is that the credit card, you get the plastic where you're able to use it anywhere that they accept that credit card, so you're able to use it in the stores. But they both work very similar. And to the point on here specifically regarding this one is that you only pay interest on the amount that you actually use. So again, let's assume you get a credit card for $1,000, and you only use $100 of it. If you do not pay it off by a certain time, which we'll go over here in a little bit as well, if you do not pay it off before the end of the statement cycle, you will pay interest only on the amount that you borrowed, not the full amount of the credit limit, which hopefully that made sense on here. So again, just kind of give that a quick example one more time. You have $1,000 credit card, you you use $100 of it, and you don't pay it off by when you're supposed to. You only pay interest on those $100, not the entire $1,000 of that credit limit. Which hopefully that made sense on here. Any questions on the slide specifically? Otherwise, I'm going to go on to the next slide. But like I said, if any questions does come up, let me know on here. And this is the one we're probably going to go back to some of those questions that Patricia had on here. So these are the different types of credit cards that exist. So the most common one is what's called an unsecured credit card. And so that is the one where you either go to a store, you go to a bank, credit union, and you apply for a credit card, and they do not require any type of collateral or deposits to secure that credit card. So pretty much they just base it off of your income and your credit. So again, let's assume you go to your bank, you apply for a credit card, and they give you a $1,000 credit card. It's not protected or guaranteed with anything, so that is what's called an unsecured credit card. Then we have what's called a secured credit card, which is something also Patricia brought up a little while ago. So a secured credit card is a very common tool to help individuals establish credit. Now, for the most part, that's what it's used for, but there's other benefits to setting up a secured credit card. But the way this works is that you secure the credit card with a deposit. usually the most common one is a deposit from $300. I have seen some places that will do like $100, and they will give you a credit card based on that amount. Some places will let you do a credit card up to 100% of what you deposit. So kind of just get into specifics. So let's assume you go to GECU and you say, hey, you know what? I'm trying to establish my credit. I want to do a secured credit card. They will tell you, okay, you need to deposit 300, and they will let you know if they can do the full 300, or some places will let you do up to 80%, which is another common one on here. But just to kind of give you those numbers on here. What happens is that they will freeze that money. They'll put it kind of in a savings account, and they will freeze that money, and they will give you a credit card based off of that amount that you can start using just as a regular credit card. Um, but what happens is that for whatever reason, if you're not able to pay off that credit card, they just take that money from that deposit that they froze, and that's how they secure it. So hopefully that made sense. And usually when I talk about secured credit cards or secured loans, I do get some questions. Anybody have questions on secured credit cards or the way they work? And I'll move on here. But again, if anything comes up, just let me know. Another very common credit card is American Express. And let me kind of pause on here. So it's really just spending money you already have for building credit. Correct, Patricia. That is a great way to put it on here. Now, accounting wise and for the books, they do put it in a separate account on here. Let's assume you go to GCU, you say I want a $300 secured credit card. You put $300 into a savings account. They freeze that, but then they give you a separate credit card. So if you look into your like online banking, you more than likely will see the secured credit card and that savings. Now that savings, it probably won't let you transfer out of it. In fact, it shouldn't let you transfer out of it. And what happens is that once you establish your credit and you are okay not needing that secured credit card anymore, you can close it down. And if there's no balance on there, you get your $300 back. Something that happens quite often is that if for whatever reason there's a balance on it, you can use that money in that savings account that is frozen to pay out that balance, and then you get that money back. Now, Patricia also asked another amazing question on here. Can it affect your credit? Yes, it can. And this goes into how credit works and all that. One of the factors on your credit report is how long you have your accounts been open for. And obviously, the longer you've had credit for, the more history that's out there, the better it is for your credit. And so, yes, it does get a little bit tricky on here. I'm just going to go into like a specific example with some of my clients that I help them establish credit so that they can buy their house. This a secured credit card usually does help them jumpstart their credit and get to a point where they're able to buy their house. What I usually do is that I will help them establish credit history, getting a secured credit card. They buy their house. I then have them establish an unsecured credit card and somewhere that they can usually use at most places. And then, depending on other factors, I might tell them it's okay to close it down, knowing that the impact won't be huge, given that they already have other established accounts. Now, I usually do tell them that if it's something they can forget about, let's assume they made a $200 deposit and they can forget about those $200 and keep that secured credit card open, that would be the best case scenario on here, that they just keep it open so it doesn't affect their score. But usually I will, for my clients specifically, I'll once I see that they're in a good established point, that they have their cars, that they have their houses, they have a secured credit card, that at that point they might not need their credit for a very long time, that by closing it, it might, if they already have established credit and all, the impact will be minimal, maybe 5-10 points. That if they're not going to be using their credit for anything immediate, at that point, it might be wise to close it down if they want to. But again, if they can just keep it open, that would be the best case scenario. And then I know Liz asked a question, might be similar on here. Does a secured credit card help your credit score as much as an unsecured credit card? And that the answer to that one is yes. For credit reporting purposes, they get reported the same way. And so there's no difference in the way it's reported. So they both help you out the same way, assuming that you use it wisely. And I have a specific slide on how to use credit cards wisely to help you out with your credit score. So we'll get into that here in a little bit. But I love it, guys. You all are asking some amazing, amazing questions on here. Another type of credit card, as somebody mentioned earlier, there's Discover credit cards, there's MasterCards, and there are Visas. Um, I usually do tell individuals to have at least one MasterCard and one Visa if possible, because they might have certain benefits each. And I know for the most part, I want to say 99% of the time, they accept Visa, they accept MasterCard, and vice versa. Um, some places will take Discover. Discover is a lot more common. And going back to the previous one, American Express. So getting into the specific of American Express, for the longest time, American Express was known as a charge card. Specifically, what that is that it's a credit card that you have to pay off every month in full. So let's assume you apply for American Express credit card and they say, okay, you can use up to $10,000. Usually the limits are much higher on an American Express credit card, but you do have to pay it off every month in full. Now, I know if American Express has made some changes that they have a regular unsecured credit card where you're able to leave a balance on it. But for the most part, and especially like those fancy American Express credit cards that are made out of metal, those are charge cards that you have to pay off every month on here. And again, another awesome question. If your credit limit is higher, will it improve your credit score? Specifically, it's more about how much you're using out of your credit limit. But let's assume you're trying to buy a house, a big investment on here. So, and I'm just going to go throw some numbers out there, but let's assume you're trying to buy a $2 million home. I know I'm getting with some high numbers on here, but let's assume you try to buy a $2 million home, and the only thing on your credit report is a $300 credit card. Even if you're using it wisely, the lender might see it as, okay, well, how are you going to go from having a $300 credit card to trying to buy a $2 million home? That is one of the factors that can play into it on here, not specifically the credit score, um, but there's more things that play into it as well. So let's assume right now you're at a 50% utilization ratio. So let's assume you have $1,000 credit card and you're using 500 of it, and you're able to get a higher limit by either calling that bank and saying if you could do a credit line increase, that can help out your score because it'll lower your utilization ratio, which hopefully that made sense the way I explained it there. But specifically addressing Patricia's question on here, it's more about how much of your out of your limit that you're using, and I'll get to that here in a little bit as well with those specifics. And then lastly, on the slide on here, one of the things, one of the other type of credit cards are store credit cards. And that one specifically are cards that you can only use at specific stores. So for example, I used to shop a lot um, at Sears. That was one of my stores on here, but as many of you all know, Sears is getting closed down. The one at Cielo Vista is very small. They don't have much stuff anymore. And I'm very fortunate that one of the credit cards that I had with Sears, they turned it into they partnered up with, I believe it's Capital One Bank or Citibank, one of them. I can't remember off the top of my head. So now it is a Sears credit card that I get special perks for using it at Sears, but because it is a Citi card, MasterCard, I can use it pretty much anywhere that they accept MasterCards. But I do have another Sears credit card that is only specific to Sears. And the reason I'm not a big fan myself of store credit cards is because if that store were to get closed down, then that card is going to get closed down eventually as well. And it's a card that you can only use at that specific place on here. It's not as common as it used to be, but I know some of the places, for example, I know Sears has a specific credit card only with them. I know some jewelry places, for example, Case Jewelers have a credit card where you can only use it with them, Hellsberg Diamonds. And so those are credit cards that you can only use at that store on here. So I'm not a huge fan. For example, something that I see often with my clients is that they'll have a K Jewelers credit card that they use to buy an engagement ring. But once they're done paying it, they really don't have a use for that credit card. And if you don't use credit cards after a certain amount of time, they can get closed down, which, as Patricia mentioned, could lower your credit score as well. So that's why I'm more of a fan of getting a credit card whether like a bank or credit union, something that you can use everywhere that they'll accept Visa or MasterCard, and not just specific to the stores, if that makes sense. And then I got another great question on here. So using 10% is better than using 30% of your credit limit. Correct. And if it's okay, Patricia, I have a specific slide with those numbers on here. So I'll get more into detail here in a little bit regarding those percentages on your credit limits and how much you're using out of your credit cards. But any questions regarding the types of credit cards on here? And again, I'll move on to the next slide on here, but if anything does come up, let me know because you guys have some amazing questions on here. But on here, these are just some statistics that I pulled off of Google on here. So average offers on new credit cards are at a 20%, 22 points interest rate, and the average existing accounts are at about 21%. The reason I'm pointing this out is because this list kind of asked you on here. Credit cards are very, very expensive way of a very expensive type of loan on here. So again, that's a whole kind of like the whole purpose behind this presentation, that we want to make sure that we avoid credit card debt and help us get out of it as soon as possible on here. But having said that, credit cards have a high rate and that they are very expensive, why would we use credit cards? And so I do want to open it up a little bit. And what are some of the benefits of using credit cards? What do you all think? Okay, you can make large purchases when you need it, for a new watch or when you don't have the money for one. Exactly, bill score enough to buy a house, car, etc. Absolutely, I love it on here. What Peter said, that yes, absolutely. And Patricia as well. So Patricia said on here, an emergency, right? Something comes up. I know on my end it was the boiler that gave out, so I had to use a credit card to get that installed and get a new one on here, and also to help you establish your credit. And the whole purpose that credit cards, if used wisely, they are able to help us out. But the thing is that most of us don't know the wise way of using it, or some of us just get into bad habits. That's why we see a lot of credit card debt and people struggling because of this credit card debt. So getting into some specifics on here. So some of the benefits that I have on here are, as Patricia said on here, cover short-term expenses on here. So an emergency comes up, you don't have the funds right now. Maybe you can put in a credit card and just pay over time, and hopefully as soon as possible, to avoid those large interest rates. And let's put on here, online purchases protection. Use credit card instead of debit card in case you need to do a chargeback. I love it, Liz. You're getting ahead of myself on here. But working in the bank, that is one of the things that we specifically kind of tell our clients, or sometimes we don't. But for fraud protection, and that's the last bullet point on here. So I'll address Liz's point here shortly. But going back to it, so promotional introductory rates. As you might see, there are some banks out there that offer a special promotion that if you get a credit card, you might get 0% interest for 18 months. Some of them are reward credit cards, where if you get this credit card and you spend $500 within the next 3 months, you might get a $500 bonus or something of the sort. So those are good reasons to use a credit card on here. But the whole point is that you use them wisely. Hopefully, let's assume you get a credit card with 0% for 18 months. Pay it off before the 18 months on here. Maybe you do have a large purchase or vacation you've been planning, and you can put it on this credit card, or you want to make sure you pay it off as soon as possible to avoid those interest charges on here and those rewards as well. So you might get a credit card that, like I said, might give you $200-300 for spending X amount of dollars within the first 3 months, which is a common thing. Use it for if maybe you are planning a large purchase, put it on the credit card, get that bonus, but then pay it off as soon as possible. One thing also is that if you do have a credit card right now that you're paying a high interest on it, you can look into other banks or other credit cards and see they might have a promotional offer for a balance transfer. For the most part, they will not let you do balance transfers within the same bank. So let's assume you have a credit card with GECU. They might not let you get another credit card and transfer that balance. But let's assume you go to Chase Bank. They might have a credit card where you're able to transfer the balance for 0% out for 18 months. That is a great tool to use because you're going to be saving a lot of money on here, where if you're able to keep the same payment, a lot of it, a lot more of it will start going towards the principal rather than interest, letting you pay it off much quicker. And then also we have points and rewards. As I had mentioned, some of them are awesome. I, for my example, use the Southwest credit card through Chase Bank. I try to put everything on there because the way I use it, I usually get about 2 round-trip flights a year for free. And that's just using it for everyday purchases. Now, I do get into the habit of trying to pay it off by the end of the month or as soon as possible to avoid interest charges. But and for the most part, I've been about that. But that is another way to use it on here as well. And then also, as Liz had pointed out, fraud protection. So the way I kind of describe this one on here is that credit card balances are a loan. So what that means is that it's not your money, it's the bank's money that they're giving you to be able to use. And so what happens on here is that if you find fraudulent transactions on your credit report, um, oh, I'm so sorry, on your statement, you can look into, you can call your bank, and what happens is that usually you tend to get those transactions reversed much quicker than if it was out of your checking account. Usually with your checking account, there's some forms that you have to fill out. There's some investigation that goes into it. So it might just take a little bit longer for you to get your money back rather than to a credit card. Hopefully that makes sense on here. What I did want to ask on here, because for some reason it seemed that I had some glitch on here. Is everybody still able to hear me on here? Awesome, perfect. Just making sure on here. For some reason it showed that I kind of refreshed the page. But yeah, so going back to Liz's point, that is an awesome tool for fraud protection to be able to use a credit card for that benefit as well. Any questions on some of these benefits of using a credit card, or I mean, does anybody know of any other benefits of using a credit card? Kind of addressing Liz's point on here. Sometimes they give discounts. Another great point on here. So, for example, let's assume you have a Walmart credit card. Um, Walmart partners up with Capital One Bank, if I'm not mistaken. But using it at Walmart might give you either cash back or certain discounts as well. Another one I know like that is JCPenney as well. If you use the JCPenney credit card, you get an additional discount for using it. So that is another great point. And another, just one of the biggest points that I'm trying to make behind this is that credit cards, if used wisely, they have some amazing benefits, but hopefully it's something we can get into the habit of paying off as soon as possible to avoid those interest charges on here. I am going to move on to the next slide, but again, if any questions come up, and on here, guys, I do have some best practices on how to use credit cards. So obviously pay off as soon as possible, use for rewards or points, but pay in full every month or as soon as possible. I do have it on here that avoid cash advances. What that is that some credit cards allow you, or some banks, I should say, allow you to take out cash from a credit card, usually just a small percentage of the credit limit, usually about 20%. So let's assume you have $1,000 credit card. Some bank will let you take out $200 in cash for whatever you may need it, but those interest rates tend to be a lot higher, usually almost in the 30%. So avoid using cash advances on here. And that's something that you usually have to do either at an ATM or going to the bank itself. So it's not something that would happen accidentally. So, but you specifically would have to go into bank or an ATM to be able to do a cash advance. You want to check your statements regularly on here. One of the points that I'm trying to make with this one is that if you make a purchase and you're able to pay it off before the end of the statement cycle, you will not be paying interest on that transaction itself. So let's assume I have $1,000 credit card. I use $100 of it today, and I see that on my statement that the statement cycle closes on the 10th. As long as I pay it off before the 10th, I will not pay interest on it. But it's another great way of using your credit card for those short-term purchases or for some of those benefits. But yeah, so you want to stay on top of your statements and also make sure that there are no transactions that you don't recognize on there. Going back to Patricia's point, you do want to avoid closing out old accounts. Again, one of us, I'll go in a slide here in a little bit. One of your measurements that is used to establish your credit score is how long have your accounts been open. So if you start closing out all credit cards, that can affect you. or it can also affect your utilization ratio. And then another great tool that many banks have is that you can set it up auto pay. That way you're not having to worry about making your payments on time as well. Another quick point that I want to make on here is that your statement cycle is not the same as your due date on here. So that's one of the things you want to look into. Obviously, you want to make sure that your payment is done by the due date every month, but also pay attention to those statement cycles, which, like I said, they're not the same as your due date on here. They usually will go, let's assume, from the 27th to the 26th of every month. I'm just using that as an example. That way, hopefully, you can pay it off before the end of the statement cycle to avoid any of those interest charges. And on here, guys, I'll go over this one briefly. This one is just going, I go over this much more in detail when I do the credit basics presentation. But this is how your credit scores are calculated. So as you can see, the biggest percentage on there is 35%, and that's pretty much are your payments done on time or not. The other big part of it is that 30% of amount of debt, and that is specific to your credit cards and how much of your credit cards you are using. And so going back to Patricia's point, the rule of thumb is that you do want to keep your balances below 30% of their limit. So for example, going back to that $1,000 credit card, you have a $1,000 credit card, try to maintain that balance below 300 in this case. Now, there are some times where you'll see a little bit of a boost on your score if you keep it even lower. So for example, sometimes my clients are a couple of points short of being able to buy their house. I'll tell them to drop their balances below 10%, and that might boost them up a couple of few points. But if you're right now, if you're maxed out on your credit cards and you want to see a big boost on your credit score, drop it below that 30%, and you'll see that usually that can increase your score anywhere from 20 to 30 points on average. Another 15% on here is how long have your accounts been open for. And so that one specifically is how the longer you've had your accounts open for, the better it is for your credit. So that's why we get into some of those conversations that we've had right now about not closing down all credit cards. Another 10% is new credit, and that specifically is for new credit applications. So as you guys might have heard, anytime you review your credit or make a loan application, it can lower your score. So that's where I tell my clients, be cautious about where you apply and how many times you apply. And the last 10% on there is what's called your credit mix, where the credit bureaus want to see that you have at least one installment loan and one revolving credit line, which in this case most common are the credit cards on your credit reports. And so that you usually do want to have at least one installment loan and one credit card on your credit reports. Any questions on this slide specifically?
What is the credit mix again? I'm sorry.
Oh, yes, ma'am. Credit mix is that they do want to see that you have different type of loans, and specifically an installment loan and revolving credit. And so installment loans are like your personal loans, car loans, mortgages, the ones where they lend you an exact amount and your payments are the same every month for X amount of months. And then the other one is revolving credit, which the most common one is a credit card. So specifically have at least one loan and at least one credit card on your credit report with payments on time and your balances below 30% of your credit limits, and that itself will get you in line to have good to excellent credit. Hopefully that answered that question on here. And going into the last two slides on here, which is pretty much about the credit card debt. So how to manage credit card debt. With some of my clients, I start telling them, stop using your credit cards. Again, they're supposed to be short-term solutions. And I know many of us, a lot of Americans have gotten into a bad habit of using them to maintain your lifestyle. But if you want to get out of credit card debts, you got to stop using them on here. A good tool is to start listing your debts, to build a budget, and to select a payoff strategy. Is there a max? And I got a question on here. Is there a maxing out of time for the credit history, like 10 years count as the max term, or is it lifetime? Good question on here. So anything positive on your credit report will stay on there for a lifetime on here. Anything negative on your report, if you don't do anything to remove any of those negative remarks, will stay on there for 7 years, which by law is the max. So let's assume I have a late payment this month. That late payment can stay on there for 7 years max. Of course, there's several ways to remove that late payment way before that, but positive history should stay on there for life. Hopefully that's what Patricia was asking on here. Awesome, guys. I'm going to move on to this next slide on here because this is pretty much what I wanted to get into on here, and I want to address any questions. So when we talk about credit card, there's credit card debt and how to get out of credit card debt. There are two common theories on here, or ways of getting out of credit card debt. So there's the snowball effect and the avalanche effect. Now, if you ask anybody that's a finance major, an accountant, they're going to tell you that the avalanche method is the wisest one to do, because what that does is it focuses on you paying off your high interest credit card balances first. So let's assume you have a credit card that's charging you a 25% credit interest, compared to your others might be in the low 20s or maybe even lower, where you want to address those high interest credit cards first, so that way you can save money on that interest, and then you start using that money to pay off the lower interest credit cards. So that one's the financially wise method of paying off credit cards. But another very common one, and I've actually seen this help out individuals more, is what's called the snowball method, where that pretty much focuses on paying off your smallest credit cards first. And that kind of goes more into like a psychological mindset on here of getting, many of us will do like a task list, and we try to get out the tasks that are easiest to complete with first. And that kind of gets us into a momentum of paying off credit cards, or completing tasks, I should say. And it's the same thought process for the snowball method, where you pay off a credit card and you start feeling good about it. You have that extra money from that credit card that you can start putting into others. And so it's more of a psychological effect, but you'd be surprised. This tend to be the most common one, I should say, for my clients, just because it helps them feel like they're achieving more. Now, it could be that coincidentally, your smallest credit card is also your highest interest credit card, and that will kind of help you offset both of them on here. But those are the two methods of the common methods that if you look up, those are the ones you usually will find into paying off credit cards. And then the next slide I just have on here is asking any questions, but I want to address this slide on here. Is there any questions or any comments regarding this, or does anybody have any other methods that you have been using in paying off your credit cards? What do you guys think about these two methods on here? Have you guys heard about them before? I have on here that yes, I've heard of one, but I don't think it's good. Do you want to share one is?
Some people I've heard, like, they will try to put all their cards on one card so they have one payment, or they'll take out a loan and then to pay everything and then pay the loan.
Okay, awesome. Yes, ma'am. And so you're talking specifically about loan consolidation or credit card consolidation, which in theory is a smart tool. But I know where you're coming from on this one, Patricia, where a lot of the times we don't have the discipline, and I just say that in general, right? But we don't have the discipline to actually stop using credit cards. But yeah, so let's assume you have a lot of credit cards, they have a high interest rate, and you find one of those credit cards that does a 0% balance transfer for 18 months. Well, that might not be a bad idea to put it all on one credit card if that is possible, hopefully with a lower interest rate that will help you pay it off faster. But to Patricia's point on here, it just so happens that a lot of my clients specifically, they don't have that discipline. They'll put it all on this one credit card, but then some way, somehow they'll still max out the other credit cards, and now they're just in a worse hole than they were beforehand. I know some people will take out a loan on here to pay off their credit cards. And again, that can be a wise method for several reasons. It'll lower down your credit utilization ratio. And that's something for some of my clients that I do help them when they're buying their house, that we do so that way their credit score can increase. But again, we just got to have that discipline into not using those credit card again, which unfortunately, like I said, what I see a lot of the times is that they'll consolidate their loans or put it on this other credit card or just get a loan to pay them off. But then before you know it, all credit cards are maxed out. So I think I know where you're coming from on this one, Patricia. And then I know Liz said on here, make an extra payment when you have extra funds in a given month. Absolutely. And that's the whole point, that we want to pay off credit cards as soon as possible. So if you are able to give more than the minimum payment, that will help you out to pay them off much quicker on here. So that is an excellent point on here. And I know some people will say, and it's one of those you got to manage, but a lot of people will say, well, out of my income tax, I'm going to put half into savings, half into credit card debt. That is a great way, and that's a wise way of looking into it. But again, how much are you earning on your interest and a savings account compared to how much are you paying out of pocket for the interest rates on your credit cards? So it's something you got to look into, that by maybe paying off the credit cards, you're saving more interest than what you would earn in a savings account. So I think that's a good point, and a lot more factors play into it, but I think that's just a good way to summarize that. Any other questions regarding the slide? I'll go on to this last one, but pretty much the last one on here, just for any questions, comments, or social observations, which is what one of my professors used to say. That's the only reason I put social observations on here. But any questions, anything else I can address? And I love it that you guys did keep me busy on here with some amazing, amazing questions. So how do you recommend we start? And that's one of the ones that I usually say, just start some way, somehow. Uh, Going back, like we are 18 to start off with credit, awesome. So if you are 18 years of age and you're trying to establish credit, trying to find somebody that can add you as an authorized user is a great way. And then if you are 18, become an authorized user, and or there are some credit building programs out there. For example, I'll type it in on here. Hopefully, I'm good in sharing this. This is a website that I like to recommend to my clients. It's a self credit builder that has an option of establishing a secured loan and a secured credit card without a credit check. So meaning that you will get this loan and this credit card as long as you follow the deposit requirements, which is a great way of helping you establish credit if you're 18, or just to establish credit or reestablish credit. Now, Liz also said, Cash App offers to lend me money. What type of loan would that be, since it's not a credit card or a bank? That The way I'm familiar with it is that it lets me on my Cash App, it'll tell me that I can qualify for up to 150 bucks, and then I paid off either weekly or at the end of the month. But then it lets me borrow against it again. So technically it would be called revolving credit. Now, unfortunately, my understanding that Cash App does not report it to the credit bureaus that you're using it. It's more like for a service that they help out with. But if it's the same type of loan that I'm talking about, where they lend me some X amount of dollars, and then I just pay it off over time, and then I'm able to use it again, and that would be called a revolving line of credit. And hopefully that addresses that question on here. And I'm kind of going a little bit fast on here, as always. So it's like a credit card. Um, for that question, Patricia, are you talking about Cash App or the self credit builder? Cash App. Correct. It's like a credit card without the plastic, if that makes sense. So it goes more into like it falls under the revolving credit, but under revolving credit, there's credit cards and a line of credit. And so it falls more under the line of credit on here, but very similar to a credit card, just without the plastic. That's the way I like to describe it. But awesome, guys. I know I kind of rushed it on here a little bit with some of those questions on here. Hopefully, I did address everything. Just know we're just about done with time on here, and I don't know how much trouble I get for going over. But any other questions or anything else I can address? But awesome, because that is what I have for you all. But once again, just thank you so much for your time. Thank you for allowing me to do this presentation on here.
Thank you so much, Enrique, for the wonderful presentation. I personally took a lot of notes and will be sharing a lot of this information, so thank you so much. In the meantime, if anyone has any questions for our presenter, please feel free to turn on your mic or use the chat box. We would like to thank everyone for being a wonderful audience and for coming in today. Please remember that we record this session, so if you'd like to review anything or share anything from this presentation, those recorded sessions can definitely help. We shared the Tejano Passport link so that everyone can receive their points for coming in today. But before you all leave, I want to share our next TDE sessions for April 10th. We'll be back in 2 weeks with Happy Math Hour at 11 a.m. where Math 1332 will cover measurement, basic concepts of Euclidean geometry, perimeter and area, and Math 2412 will cover binomial theorem and counting principles. Our 1 p.m. session next week, or sorry, in 2 weeks, will be on Microsoft 365 and OneDrive with Janine Rudnick. Thank you all for coming in today. We hope everyone has a restful and safe weekend. If you have any questions, please feel free to use the chat box or your mic. We hope to see you all again for Tejano Virtual Events.